Good morning, everyone. Yesterday, in the previous session, we have seen the need for accounting, what for the accounting, financial accounting is required, what for it is prepared, and how the businessman can take decision with the help of the financial statements, finalized financial statements. All those things we have seen in detail. Today, in continuation of that session, we are going to see accounting concepts and conventions. In continuation of yesterday's session, today we are going to see concepts and conventions. That is considered to be very, very important as far as financial accounting is concerned. Now, before starting accounting concepts and conventions, I would like to brief the previous session to have continuity for the current session. Let me go in a rapid way. Let me finish it very fast, or within a few seconds I will be brushing up those previous sessions contents. First of all, we have seen need for accounting, then accounting as the language of business. Then we have seen definition of accounting. You know very well about definition. Accounting is the art of recording, classifying and summarizing in a significant manner and in terms of money transactions and events which are of a financial character and interpreting the results thereof. So this has been defined by American Institute of Certified Public Accountants, AICPA in short. Then we have seen attributes and steps of accounting. Then what is the difference between bookkeeping and accounting? Then we have seen objectives of accounting, and then what are the various advantages of accounting, then limitations of accounting, and who are all the persons using this financial accounting, otherwise called as internal users of accounting information, we have seen. And then branches of accounting. There are major branches in the accounting field or area: financial accounting, cost accounting, and management accounting. These are all the main branches of accounting. And then methods of accounting we have seen, that is single entry system and double entry system of accounting, that is coming under methods of accounting. Then meaning of debit and credit. What do you mean by debit and what do you mean by credit, which is derived from the Latin word. If it is debit, debitum was the originality, was the Latin word, and debitus derived from debitum, which means due from that. Similarly, the word credit means, which has been derived from the Latin word credar, C-R-E-D-A-R, credar. Credar means due to that. That is the English meaning of credar. So in short, you can call it as a credit, CR. So DR means debit, CR means the credit. Then advantages of double entry system. Then we have seen types of accounts, golden rules of financial accounting. What are they? There are three principles. Yesterday I was explaining in the previous session. One is personal account, debit the receiver, credit the giver. Then real accounts, debit what comes in, credit what goes out. Then nominal account principle says or insists under nominal account principle, it says debit all expenses and losses, credit all incomes and gains. So we have seen three golden rules of accounts, and then basis of accounting. What are the three important bases? Cash basis, number one. Number two, accrual or mercantile basis. Number three, mixed or hybrid basis, which will have both cash basis accounting as well as accrual basis of accounting. So this has been explained till this we have explained in the previous session. So I have just given you gist about the previous session. Now I am going to continue the present session. That is nothing but I told you accounting concepts and conventions. Before that, I would like to explain you what are the accounting terminology involved in the financial accounting. Number one, capital account. What do you mean by capital? Capital is nothing but an investment by any individual or by the businessman or a trader or a sole proprietor or by any person for that sake. So capital is nothing but the initial investment required to start a business. It represents owner's funds invested in a business. It may be the original amount invested by the owner or original contribution adjusted for profits and drawings. It is also known as owner's equity or net worth. Capital represents owner's claim against the assets of the business of the. We can say, suppose he is bringing in money into the business. In a nutshell, I can tell you, suppose a person is bringing money into the business. That money literally will be called as cash, or which may be invested in bank. That money is nothing but classified as asset. Cash is classified as current asset, highly liquid in nature, so it should be called as asset, current asset. Similarly, the capital account, it's a nominal account, so which will be shown under the liability side. Capital account is shown on the liability side, which is nothing but the owner's equity. So owner's claim against the assets of the business. Then comes liability. Next to capital, then comes liability. What do you mean by liability? It represents temporary interest of outside creditors in the assets of your business. Okay. Then, in simple words, we can say debts repayable to outsiders by the business are called liabilities. Then third one, assets. Assets are defined as anything of value owned by a business. Assets are future economic benefits, the rights which are owned or controlled by an organization or individual. Then comes revenue. What is revenue? It is defined as the inflow of assets which results in an increase in the owner's equity. It includes all incomes, like sales receipts, interest, commission, brokerage, etc. However, receipts of capital nature like additional capital, sale of assets, etc. are not part of your revenue. Understood? Then expense. Fifth head, that is fifth terminology, accounting terminology is expense. It is any amount spent in order to produce and sell the goods and services, which brings in the revenue. Expenses may be defined as the cost of use of things or services for the purpose of generating revenue. Then expenses can be capital expense and revenue expense, which can be classified into two. Capital expense generates revenue over several accounting years. Revenue expense generates revenue in the current accounting year. That is the basic difference between these two. Then sixth terminology, debtors. A person who receives a benefit without giving money or money's worth immediately but liable to pay in future is a debtor. Debtor can be a trade debtor if he buys goods on credit. Others are non-trade debtors. Then comes creditors. Seventh terminology, creditors. A person who gives a benefit without receiving money or money's worth immediately but liable to claim in future is a creditor. Creditor can be a trade creditor if he supplies goods on credit. Others are non-trade creditors. Eighth one, tangible assets. Assets which have physical existence, that is, they can be seen or felt or touched, or termed as tangible assets. Example, cash, machinery, buildings, which you can see literally. That is called tangible assets. Intangible assets are assets which have no physical existence. You cannot see it, you cannot touch it, you cannot feel it. That is, they cannot be seen or felt or touched, or termed as intangible assets. Examples, goodwill. Goodwill cannot be seen with your naked eyes because that is intangible asset. The name, the fame which is getting aggravated, or you are getting more and more famous in the society, or your name is getting very famous, like Saravana stores and some other jewelry like Lalita jewelry or some other jewelry. They are getting a name by the way of doing reputed business. And moreover, patent rights, copyrights, trademarks, which are otherwise called as intellectual property rights. With the help of your brain, human brain, which is created, which you cannot see literally, and which is otherwise called as intangible assets, which has no shape, which has no kind of physical existence. Then comes fictitious assets. Items shown along with the other assets on the asset side of a balance sheet, but actually representing unadjusted losses are termed as fictitious assets. Examples: preliminary expenses, that is, at the time of starting the business, you may have to incur certain expenses. That is called preliminary expenses at the time of starting your business, right? Which is inevitable for any businessman. Say, for example, at the time of incorporation or at the time of registering your firm with the registering authorities. Then profit and loss account, debit balance, etc. These are all nothing but fictitious assets. Then vesting assets, number 11, vesting assets, WASTING, vesting assets. What do you mean by vesting assets? Those assets which certainly lose value with usage or termed as vesting assets. Mines, ores, forest, etc. Because by using those assets which will lose its value, once if you start digging mines or ores, it will lose its originality. That is nothing but that is coming under the vesting assets. Become waste once the mineral is fully extracted or the timber is fully cut from the forest. It will become empty. Understood? Now, fixed assets. Fixed assets are acquired for income generation, but not for resale, or called fixed assets. Suppose you are buying a machinery for production purpose. You are starting an industry. You are going to engage yourself into manufacturing activity, and you are going to use that machinery for the purpose of production, not for resale. So those assets are considered to be fixed assets. Okay. Then number 13, current or floating assets. Those assets which are converted into cash in normal course of business in less than 1 year are termed as current or floating assets. Example: stock, debtors. Stock can be liquidated at any point of time or maybe within 1 year. Similarly, debtors can be collected within 1 year time. Nobody allows a debtor to pay for a longer period. He may delay for 6 months, but not 1 year. If he is allowed to pay after 1 year, that will become doubtful debts. If it doesn't turn up, if you are not able to collect the debtor at all, then you will be termed as bad debts. An amount which you cannot recover it back is called bad debts. So, stock, debtors, and one more asset I told you already, cash. These three are considered to be current assets. Highly liquid in nature. Anytime you can convert it as cash. Then comes purchases. Buying of goods with the intention of resale is called purchases. If cash is paid immediately for the purchase, it is cash purchase. If the payment is postponed, it is credit purchases. You are paying cash and buying goods for the purpose of resale. Suppose I want to share one example. Like if you are doing a rice merchant business, suppose you are selling rice in the wholesale market, you are buying rice from the producer or manufacturer, and you are selling in the retail market. So you are buying for cash and selling for cash. Both activities are involved in cash transactions. And you are nothing but your rice is your raw material. Your rice is considered to be goods. You are purchasing it and selling it for margin or profit. Now, sales. What do you mean by sales? Selling of goods in the normal course of business is termed as sales. If the sale is for immediate cash payment, it is cashless. If the payment for sales is postponed, it is credit sales. Then 16th accounting terminology is nothing but stock. As I explained to you, cash, debtors and stock are considered to be current assets. The term stock refers to goods lying unsold on a particular date. The stock of goods at the end of the accounting period is called closing stock, and the stock of goods at the beginning of an accounting period is called opening stock. So once again I would like to share where it will be shown also. Opening stock, debit side of your trading account is shown. Closing stock, credit side of trading account, and also on the asset side of the balance sheet. Clear? Now, 17th terminology is losses. Loss really indicates something against which a firm receives no benefit. It represents money given up without any return. It may be noted that expense leads to revenue, but losses do not. Example, loss due to fire. Suppose a fire accident is happening in your factory or your manufacturing unit. That is coming under these losses only. Theft. A theft is happening. And then damage payable to others. Suppose you are paying damage by way of something is happening in your factory, you are paying compensation. Like that is also considered to be a loss only. Then 18th terminology, drawings. Any amount of money or money's worth withdrawn by the owner's proprietor of the business is termed as drawings. It is usually subtracted from your capital. I can call this way. Suppose the rice merchant is selling rice only, and instead of cash he is withdrawing some rice from his shop for his personal use. It will be considered as drawings account. So we have to debit drawings account and credit purchase account, because he is consuming that rice for his own purpose. In that case, we have to debit drawings account. If he is taking some money from the petty cash from the counter, then for personal use, it will be considered as drawings account. Drawings account debtor to cash, which affects cash. So then, this is 18th terminology we have seen. Then 19th terminology is invoice. What do you mean by invoice? It is a statement prepared by a seller of goods to be sent to the buyer. Here it shows details of quantity, price, value, etc. of the goods, and any discount given. That is nothing but trade discount. Generally, I would like to share that information with you. Generally, the trade discount is shown on the invoice, but not the cash discount. At the time of collecting cash, you will be giving discount. That is nothing but cash discount. That is the basic difference between trade discount and cash discount. Trade discount is shown in the invoice, but cash discount is not shown in the invoice. That is incentive given to the other person, to the debtor, and who is motivated by taking or offered to give a discount by way of motivating the debtor for fast settlement. So if he gives money on particular date, he gets discount. So that is the only aim. That is the objective of the cash discount. Whereas trade discount is standard discount, which will be shown on the invoice, and generally it is deducted from the basic price. After that, they will be adding sales tax or whatever. Then 20th, vouchers. So 20th terminology is voucher. It is written record and evidence of a transaction. So documentary evidence of any transaction is called a voucher. Why we are saying that? This is ultimately a supporting document for each and every transaction. Vouchers are essential for auditors. So each and every auditor is insisting on vouchers. That is the documentary evidence that is prepared based on your transaction each and every time. Example, checkbook counterfiles are considered to be vouchers. Cash receipts. As soon as you receive cash from a party, immediately you are preparing one cash receipt supporting that particular transaction. Or invoices are considered to be a supporting document, which will be vouched by the auditor at the end of the financial year. Then 21st accounting terminology is goods. The term goods includes all merchandise, commodities, etc. in which a trader deals in the normal course of business. Thus, commodities bought for resale are treated as goods. For a furniture dealer, furniture is goods, but for a rice merchant, rice is the goods. For a ready-made shop owner, ready-made goods are considered to be goods. Similarly, for a coconut trader, the coconuts are considered to be goods. Which is, go on. Other firms are there, they are whatever they are dealing with, that is considered to be goods. Then current liability, 22nd is current liability. Those liabilities which are payable within 1 year in the normal course of business are termed as current liabilities. For example, trade creditors, bills payable. These two are current liabilities. Even outstanding expenses, outstanding charges or expenses are considered to be current liability. Suppose you have to pay rent, outstanding rent is considered to be current liability, which is shown under the current liability. Long-term liabilities. Liabilities repayable beyond a period of 1 year or treated as long-term liabilities. Example, bank loans, mortgage loans. Sorry. Then 24, solvent. A person who has assets with realizable values which exceed his liabilities is solvent. Then insolvent. Who is insolvent? We can call a person whose liabilities are more than the realizable values are considered to be insolvent. Who becomes an insolvent because his liabilities are more than the assets, realizable values of his assets, who is called as insolvent. So with this, the various terminology of accounting we have seen. Then we are moving on to accounting, basic accounting concepts and conventions. So what do you understand by basic accounting concepts and how it has been developed? What are all its characteristics? We are going to see. Then meaning and classification of accounting concepts and conventions. Let me start from the beginning. What do you mean by accounting concepts? See, as we have seen, it records, classifies and summarizes all the financial transactions are considered to be. Meaning of accounting, we have seen already. These are all taking place in the business. It communicates the results of the transactions in the form of financial statements. Finally, the trading P&L account balance sheet is prepared based on these transactions. Different accounting principles, postulates or concepts and conventions were developed over the years, which act as the basic points of agreement on which financial accounting theory and practices are founded. The generally accepted principles were evolved from common experience of accountants, historical precedents, regulations of government agencies and statements from professional bodies, Chartered Accountant Firm, Institute of Cost and Reverse Management, and company secretaryship. All these are considered to be the government agencies. Then we can call it as institutes, professional institutes run by the government according to the legislation, the constitutional legislations, and statements from professional bodies. So professional bodies like the Institute of Chartered Accountants of England and Wales, they are also paves way for the accounting concepts. The American accounting associations, the American Institute of Certified Public Accountants, the Institute of Chartered Accountants of India have evolved, modified and codified the different principles, concepts and conventions of accounting. So they are all involved in forming these accounting concepts and conventions. We are following on those root path. Right? These principles, concepts and conventions provide uniformity in preparation of accounts. That is the aim of preparing financial account. It should be uniform throughout the world. Of course, in India, which has to be prepared in a uniform way throughout India. I understand. Have you understood? They are the general guidelines to sound accounting practices, the facilities, the understanding of financial statements by the end users. The principles are acceptable because they satisfy three basic criteria, certain criteria which are listed below. Please, are you able to follow? Please. So number one, utility or relevance. What is the relevance? What is the need? What is the utility part? How far you are utilizing? That is very, very important. The principles are invaluable in providing more useful, necessary and relevant data to the interested parties. Number two, objectivity. Number three, feasibility. So these are all the three basic criteria of using accounting concepts and conventions. What are the important characteristics? So with that, I will just close this session. Further, I would like to explain the meaning and classifications of accounting concepts and conventions in the next sessions. So let me finish up with the characteristics. The accounting principles are developed for practical purposes. They cannot be validated or proved like the principles of mathematics, physics and chemistry. They are the best possible suggestions based on practical experience, reasoning and observation of the professional accountants. Number two, the principles are for common usage to ensure uniformity and understanding. Number three, they are not specifically made or legislated by any government or legal authority. They are not legally enforceable. Number four, they are in the process of evaluation and are likely to change as per the dictates of changing circumstances and technology. Change is inevitable for any field. Like that, accounting is not deviated from that or excluded from that. So these four characteristics are very, very important. So with this, I would like to finish this particular session. I just explain you what do you mean by accounting concepts and conventions, what are all its basic criteria and characteristics. So in next session, I would like to share about contents about meaning and classification of accounting concepts and conventions, which are actually that will take one session to explain you about the accounting concepts and conventions. Thank you very much, one and all. Thank you.